Good afternoon, everybody. Welcome back to the Opportunistic Trader. We're joined by Tom McEntee. Tom is a former floor trader, very talented equity trader, and really looks at options, equities, looks for good risk-reward opportunities to get involved in the market. And Tom has been joining us regularly, showing his screen, showing what he looks at, the way he scours the market, and so it's really interesting. Tom, how are you?
Very good, Mike. Thank you for having me back.
Absolutely. So I know you've been pretty active. The market is volatility's picked up, and you've had a number of trades. I know you wanted to start out by looking at a trade that you started putting on last Wednesday in the SPY. Take us through that.
Yeah, sure. Yeah, sure. Last Wednesday in the SPY, 12:30 time. You can go check it out. Full disclosure. I'm only commenting on my winners right now, so bear with me. I bought the November regular way November. I think we were trading 292ish, give or take. Regular way November 290 puts. That's November 16 expiration. 290 puts. And sold regular way December, that's 12/21 expiration. Regular way December 275 puts and I paid a dime. I paid a dime for that. I paid for that. I'm sorry, I paid 70. I paid 70 cents for that spread. You can go back and look at it. It was 12:33 time last Wednesday. I paid 70 cents for that spread. I also bought another spread. I bought same way, no 290, sold deck 280, paid a dime. Now I was looking for maybe a move down to 287 ish. A lot of negative divergences that I try to follow that I haven't seen in about in a couple of years. I think since that 100 handle down day back in August of 15. At any rate, I'm looking for some type of 10% correction, somewhere in there. So 262 is in the spot. Anyway, what I did was I'll show you why this trade worked. I bought the 290 puts regular way November, sold December at 275. I paid 70 cents for that spread. That spread is now worth $2. Okay, so you got roughly 3x on that thing, and it was a little bit better obviously this morning. Point being, if you're able to buy it so cheaply, because look what's happened to volatility here in the last couple of days. Now, if you look here, what I'm focusing on here is these are regular way November 16 options, trading about a 12 volatility, and these are regular ways. I move my cursor over. These are regular way December options. They're trading about a 12 and a half. So essentially, December's roughly zero point 0.3 clicks over, right? 0.3 volatility points over November. Now, last Wednesday, that skew was much greater. It was somewhere around 2 clicks, or I could buy November and sell December. I was buying November. We'll keep it, apples to apples. I was buying November under 10 and selling December somewhere around a 12. Now, 2 clicks is 2 clicks, but 2 clicks is even more dramatic when when the at the money 30-day vol is somewhere around 10. It represents a 20% premium to current 30-day volatility level. So that's why it's attractive. And it was at the time the delta was probably around 15 to 20 deltas. They call it 17 deltas on the short side. But it only cost me a dime because I was selling duration. The December series expires 5 weeks later. I was selling duration, and I was also scalping out calendar skew, which Mike and I have spoken about frequently during this this 45-minute thing we do every week. So we're scraping out calendar skew. We were selling Vega. We were selling volatility, okay? Because we're selling volatility in December and buying it in November. And since we did it, we were contract neutral, and the durations were fairly close together, i.e., 1 month apart. We're a net seller of volatility, but we were a buyer of gamma, and gamma is, as we all know, rate of change of delta. So as the stock moves up or down, your delta will change accordingly. Now, I have more gamma because I am long the near-term option, or the nearest strike option, the 290 line. So as the stock went through 290, my short deltas go from short 17 to right now they are, here we are, where are we, 288-ish or something? Let me just bear with me here. 287.27. So we went from, I was maybe a 17 delta to now it's about a 57 against 26. Now it's a 31 delta. I think I put on I think it was like a 15 delta. That was a 31 delta. So I picked up another 15 deltas on the short side as we went down. And now another thing happened. So like I said, I sold Vega, all right? But I sold Vega at plus 2 clicks. As we see here, November's now trading at 12. December's trading at roughly 12. So that spread, that skew has shrunk up dramatically down to where it's almost flattish. So I made money both ways there. I made money on gamma, which affected my delta, which allowed me to be shorter on the way down. I'm getting shorter as we go lower. And the fact that it happened as quickly as it did, I mean, I would attribute that to dumb luck and nothing else. But the fact that it happened as quickly as it did was obviously much better for me. So I made money because of gamma, and I made money because the skew, the volatility skew between the two collapsed. So I think when you see an opportunity to do things like this, where I can get downside exposure for a nominal cost, and I'm taking advantage of volatility metrics that present themselves where I've got to be, I could have been dead wrong, there's no question, where I got to be real wrong to lose money on this trade. Any type of down move there, as I looked at it, I was going to make money. Even if the calendar skew didn't collapse, because it was so cheap. November was being given away because to me, I've been doing this a long time, and Larry would probably echo these sentiments. It looks like put buyers gave up, vol buyers gave up, shorts gave up. Everyone kind of threw in the towel because every time every decline you got was eagle that was greedily bought up, and the pullbacks became shallower and shallower. So I think you hit some type of nadir or reverse inflection point in volatility at that point in time. And that's why that structure worked. Now that's 3x. That's not a bad return. Now the other one there, the 290, 280 is roughly about 90 cents. It's about 90 cents right now. I paid a dime for that. Now my trade's morphed into something else. Obviously, I've moved. I've bought stock, sold stock, and rolled into different options. But these are the kind of things that are apparent there if you maintain discipline and stay patient. Now that's one that worked, and that's why it worked. When you see things like that. Now conversely, here we see, and let's morph into real time. Look at the trades. I gave a trade this morning and yesterday. There's two of them. Yesterday, I think Friday. Let me just go. I'm going back to the here. Let's look at this one here from 10:10 time in the equity page. Seagate Technology, STX, symbol STX, Sam Thomas X-Ray. Okay, I traded this thing, I'm going to say Christmas time through May, somewhere in there. And I probably net lost money on it, I'll be honest with you. Lost money, was short at the wrong prices, and just kind of butchered it. But I got a pretty good memory, and I know kind of where the stock is in relation to where it was. I know I kind of have a decent memory when it comes to gaps and charts. So when I saw Seagate trading at 45-ish this morning, or 44-ish, I know there's a gap somewhere around there from an earnings day back in January. And indeed there is. There's a gap down to about the 43.18 level from January 8th of this year. Now you notice I'm bidding 43.20 or something like that. It's in the chat. Traded down to 43.50. I think this stock will probably fill the gap. That said, now that it's filled the gap, I would look to do something I would look to leverage some type of perhaps an oversold condition with elevated volatility, elevated implied volatility. Now here's Seagate. I'll put this in. You get an example of what I'm talking about. You'll be able to get a look at what I'm talking about. All right, so Seagate now. Earnings come out, I believe, Nov 1 or Halloween, somewhere in there. So the Nov, I'm sorry, no, it's actually after that. It's somewhere like the middle of the first week of November. They're kind of nebulous on the exact date. So I'm using November 9 as the earnings tenor. Okay. So now volatility in there, as I put my cursor over, roughly about 49. All right. Now, as I look here, if you just follow me, the at-the-monies are roughly 40. The stock's roughly $44, let's say. So the at-the-money is about 51. We go up to 50 in the stock. It's 48. So the skew is kind of minimal, almost flattish in terms of, you're talking about maybe 2-3 clicks in skew. Maybe that's kind of normal. 3 clicks in skew between 45 and 51, which is nice. It's kind of flattish. So there's really kind of flattish skew where you can leverage an upside look by selling out of the money calls at the same volatility which you're buying in the money calls. But let's look at this. This is what I think is very, very important to look at. Here is where we are. This is the 30-day vol right now. Now, obviously, 30-day vol is going to be inflated for obvious reasons. Stock, pardon my hyperbole, about cannonballing lower. And there's a 32-week median, and this thing's been about 32. All right, now I got involved with this thing in December. I remember Vol being in the mid-20s. So I went back and looked, and actually XDM45, who is a subscriber in here, asked as to why I did that. If you can see 10:12 a.m., XDM45 is an excellent question. I went back and looked at where Seagate Vol was 1 month pre-earnings. And I actually went back 8 quarters, but I only cited 5. Seagate Vol was roughly, it'll typically trade at or near 50 on the earnings month, the day of earnings. But before it's been as low as, and I can check my answer, 30 days pre-earnings in January, 30-day implied vols were 21. 30 days from the May 1 earnings, it was 51. And 30 days from the July earnings, implieds were 41. Today, it's 50. Now, I will say that the April earnings were after the stock had made a hyperbolic, or I should say parabolic move to the upside. As you can see here, I mean, this stock, and like I said, I was dead wrong, so full disclosure. Dead wrong on the thing then. Here's a 1-year chart. Hopefully that'll hit up. Okay. Now here's where I got involved with it. Here's the gap I'm citing from right here. The high that day was 42.99 on 1.5. All right, then 1.18 we traded. The low was 45 something, 45.62. We're in the gap. We're in the gap zone. I see Rod Serling probably. He's coming through your TV screen right now. So I'm looking to fill that gap. Now look at this move here from January. Here we're trading $43, and we're at 62 in 3 months. So that's roughly what, almost 50. That's almost 50% in 3 months. And indeed, if you go back to October, I mean, like a year ago today, October 17, stock was as low as 33 and got to 66. So 29 is roughly, what's that, close to about 88% ballpark from October to April. Six months, 88%. Well, that's the way rational markets typically move, obviously. Because I guess they get involved in, if you remember, if I'm not mistaken, if you check the headlines, they got involved in cryptocurrencies there. So that was all the rage. So I guess that might have fueled it, among other things. Anyway, this is what I'm looking at. I think it's back in here. Now I'm seeing volatility as an attractive level to sell them. And I want to leverage this gap fill. Hopefully I'll get filled on the stock with the moving average. And maybe I'm looking, I would look somewhere in here. This recent high over here is roughly, what is it, about $57? I think 57.20. 57.20. I mean, the low is going to, I'm assuming 43, so roughly 100. I'm looking in here. I'm looking for another gap fill. This low is 48.27. I'm going to target that. I'm going to target. There's a gap here from, what is this, 51.43. This low is 48.48. Yeah, I'm going to look at here, $52. I think the stock has a chance to challenge the bottom of gap here, $51. I want to leverage something around that. So what I fashioned in this thing is I want to buy a call tree. Now, a call tree, a ratio spread is 1/2. A call tree is essentially the same thing, but it's a variation on the theme. So that would be I want to buy a near-term call. If I'm bullish, I'm buying the tree, and sell 2 out of the money options. So what I want to do here is buy the, I think it was a 48, 50, 52. I didn't get it yet. Here, I can buy the, I'm bidding a nickel credit. If you look back here at 10:10 a.m., I'm bidding a nickel credit for the November 9 expiration, 48, 50, 52 call tree. Okay, I want to buy the 48 calls. I want to sell the 50 calls. I want to sell the 52 calls. I can take in a credit. I want to take in a nickel credit on that. Now that spread is going to be a huge winner. Obviously, the stock goes to 50. I mean, the stock goes to, if this stock rallies to 46 in the next 46, 47 the next week, that spread's going to expand because the volatility should come in a little bit. Now, obviously, in an ideal world, we go to 50 after November earnings. Well, after November earnings, even 52 after November earnings. Right? Because I'm long with the stock at 50. What are my 48s worth intrinsically? With the stock at expiration, like 48s are worth $2. 50s and 52s expire worthless. So the spread's worth 2. I'm paying it. I'm taking the credit. Say I do it for nothing. I paid nothing for it. I make $2. Stock goes to 52. The 48s I'm long are worth 4. The 50s I'm short are worth 2. 52s I'm short of were zero. So I make $2 on that. So now it's important. Now we say, where do I turn down? Well, my room in this thing is, I got room up to 54 on the stock. With the stock at 54, my 48s are worth 6. The 50s, the short 50s are worth 4. This is all intrinsic value at expiration. 52s, the stock at trading 54 worth 2. So it will be 6, 4, and 2, be 0. That's my break evens. I'm targeting, it may have a chance to go to 54. But if I get to anywhere between 46 and 50, it's a home run. I can run away from this thing and probably take in $1, or probably like 80 cents to $1. That's why that works. I'm selling higher volatility than what normally presents 1 month pre-earnings. That's all I'm looking to do. That's interesting. We talked about, there's another trade I gave on Friday afternoon. In the middle of the tumult, like in the song "Evolution" by Pearl Jam, buying stocks on the day of the crash. Let's look here. I bought this spread in IWM October 19. I bought the 165, 167 1x2. End of the day Friday. It's in there somewhere. Okay, I mean, the stocks. I paid. What did I pay for this thing? I paid 7 cents for it. I bought one of the 165s. Sold 2 of the 67s. So it's roughly now, figure 46 against 17, roughly 12 cents. Big deal. It's a scratch. Point being there is, all I want there is any type of move up to 162, 163. Spread's worth 35, 40 cents in a week. I paid 7 cents for it. I'm just want to leverage. I'm leveraging the higher volatility. Now, IWM vol is like, it's 14 now. It's coming a little bit today. It's 14 of these out of the money options. It's 16 at the money. It's typically somewhere around, I believe, 13.5, give or take. I'm sorry, 13. Trading 16. So I'm looking to sell that. For the same reason I was looking to buy stuff 2 weeks ago and a week ago, I'm looking to maybe take advantage and sell stuff in other things where I think you can take a cheap long side look in IWM. And everybody out there who's listening to this who hasn't fallen asleep yet, so they ask themselves, okay, if I do this 165, 167, 1x2, where do I lose money? So they got to say, well, I paid 7 cents for it. My break even would be 168.93, right? Because the width of the spread is $2, double it, it's $4. So you add 4 onto 165 because you sold 2 of the 167s. You add 4 onto 165, you get 169 minus your net debit. The net debit, my net debit was 7 cents. I break even at that's my upside break even, 168.93. Okay, now at expiration, I would need to stock above 165 to make money. I'm looking for anything. If I get to move to 163, excuse me, if I get to move to 163 by the end of this week, say for argument's sake, that spreads 40 cents because I'm net short options. I'm net short the 167s that are going to be $4 out of the money with a week to go. Probably trading around a nickel. The 165s, excuse me, the 165s with a week to go in the stock. October 19th. The 165s with a week to go in the stock, say $2. Stock $2 out of the money, probably trading somewhere around, I would say, a little bit higher than they are right now, maybe 55 cents. So I think the spread would be somewhere around 45 cents. So, I mean, I paid 7, it's worth 45. I'm making 38, that's 5.5x in my book. So that's IWM. The trades we talked about last week. Mike, we talked about Facebook, right?
Yeah, I was talking about that yesterday, actually. The market got pretty pessimistic, and you were looking to dip your toes in there, and, I
dipped my toes. I'm not a very good swimmer. So here's what I did. We talked about this. This was on our chat last week. And here, look, the stock was higher, I think, 161. I mean, I still like the stock. It's unloved, hated, I guess, just to a certain extent, just by Apple and sell Facebook. That seems like a natural do.
Goes for about any stock.
Yeah. Completely unloved. Nobody wants this thing here. At 221, it was like, I remember the Nigerian guys. This is like the greatest, but this is the greatest thing on Wall Street. Now it's anathema. Got to get it off my sheets. Okay. So I think what we did, I think I wrote it down. Yeah. Last Tuesday, we bought and I put it in the chat, I bought it. Deck 80, regular weight Deck 80, November 2 expiration, 175 call spread, Paid 81 cents. That was last. I think the stock was 162-ish, ballpark. Okay. Now you see where it is now. I mean, I'm wrong on that spread there. Is I'm trying. It's kind of parallels what I'm trying to do in IWM, and what I'm trying to do in Seagate. I haven't been filled in the Seagate spread. That's what I'm looking to do. Now, the November 175s, I'm sure, are roughly right. I figured this is I'm on tape delay. I realize that roughly 2.25. Okay, and now the deck 180s are roughly 257. We'll say so. The spreads deck one. I'm sorry. The deck 180s are 257. The no second 175s were $1.56. So the spread's a buck. I paid 81 cents. Now, why is that winning? Stock's going lower. I want the stock to head towards 175. That's right. But that's the wonderful thing about the calendar spread here is that I have, at that time, look at what I'm doing here. I'm selling now. It was a little bit different. I think might have been a little bit lower when I did it. I'm selling the earnings month. Hey, it's roughly 41. As you see, I'm highlighting up here. Roughly 41 at the money in November, and rightfully so. Hey, it's going to look that straddle. I mean, where's the stock? 160 roughly right now. Straddle's $14. The straddle's $14, and the earnings straddle. What's going to be interesting is like the straddle. The straddle's typically been about as high as 7% in the last. The at the money straddle day of earnings has been 7% the day of earnings. So that would imply roughly an $11 straddle at these levels. I would imagine it's probably going to be higher. I don't know how much higher, but I could see the straddle trading somewhere in here. But by the same token, that's going to raise all boats in the back months. So what we have on here is we bought the Decembers, we sold November. Now we took right now that spread is like roughly 33 in December, as I'm highlighting, roughly 41. I'm just doing at the money. I'm not going to show you the skew between the out of the money stuff. I'm taking in roughly 8 clicks. Now, if I get any type of up move in this thing, say we get to one. Look, I mean, I know it can't go. Let's see if we get to 170. Oh, these go out worthless. My 180s are getting my December 180s. Even if I collapse the vol down to 20. Are probably still going to be right around here, 3 weeks from now, 257. So I mean, I'm going to bet probably be a little bit higher, about 3. I would say 315. So 315, it'd be roughly 3x right here if I get to 170 in the stock. I got break evens that from 151 up to 186 at expiration. Now that's a real good risk reward trade. Now, Mike, you wanted to talk about what we're going to be doing in the future about some earnings stuff coming up in the next couple of weeks?
Yeah, absolutely.
Well, we're going to do this on, I guess,
we're talking next Wednesday. Maybe we'd start having you kind of come on and take a look at the upcoming earnings releases and opportunities that might be presenting themselves in the option world. Yeah,
I think we could start. I'm just saying, if I'm coming on next Tuesday, we could start it right there because a lot of stuff comes out. This is October 16, after the market closes. Netflix, Beam.
Oh, that would be perfect.
So we'll talk about it next Tuesday. And I think if you want to do next Wednesday, that's cool because it looks like whatever you want to do. I could do next Tuesday, next Thursday. Very busy. Thursdays are always big. Thursday after the market closes. Let's see what we got here. American Express, E-Trade. I'm just trying to think. I want to do what people are trading, right? Obviously. So.
Yeah, like you said, Thursdays have a lot of different ones. But we'll take a look at that. That'll be pretty interesting. So you can take a look at some different option opportunities heading into earnings season.
Yeah, because I think also that it'll be. Let me see one second. Let me just see if I'm not missing anything. Yeah, let's do Tuesday, Thursday next week. Look, what we're going to be focusing on. Mike had a great idea. We'll be focusing on stuff where earnings that are coming out that night or the next night or the next morning, whatever the heck it might be, and fashion some type of. You're just trying to leverage technicals with vol metrics that are apparent in the earnings month. Now we're gonna be getting earnings there and try to fashion something around there. Now this thing I use here, it is on tape delay, but it's got some great bells and whistles that I use. It gives me a lot of great earnings stuff. Really, a lot of good stuff that I find invaluable. Like this comes out next week. I'm just gonna go top of my head stuff here. Here's Netflix. Everyone loves Netflix, right? I mean, let's look at this here. I'm going to look at the earnings history of Netflix.
Everybody loves the product. Not sure about the stock.
I do love the product. I will admit that. Now, it's coming out the 16th, so that's Tuesday night. So we're going to have 3 days, and this is the way I fashion these things. These are the kind of ways I think. So this is your inside look into a depraved mind. I want to look at if I'm going to do something in that earnings month. Now, I think a lot of these guys say, hey, well, the implied straddle's 8%. That's freaking great. I don't really care about that. What I like to look at is, where is max pain? Where is, what has been the max move in this stock if I'm long or short the weekly tenor, the earnings tenor? Say that would be October 19 expiration. I'm going to get optionality Wednesday, Thursday, Friday, right? Earnings come out. I got to get paid one way or the other, long it, short it. I got to get paid in 3 days. So what has this stock done 3 days post earnings? So now this thing gives me a great look here. Now this is July 16, the last earnings in Netflix. Now my 2-day look is this. If you look here, this thing closed at 400 on July 16th. If you look, I got to move my thing out of the way. It closed about $400 on July 16th. Now the max move, the low 1 day later was 344. 56. That's a 14% move. So so that's 2 days. I'll go out 3 days on this. I want to say, well, I got Tuesday, Wednesday, Thursday, Friday. What's the max move? And try to target. And I'll take all these max moves. I'll go back typically 8 quarters. Take out the max move up or down, wherever that is. The max move was 10%. It went higher. That's great. Fashion something up there. I'll get out the max move. Try to come out with what the median and mean was. Try to get some type of standard deviation action going, and then try to develop some type of strategy around that, and try to leverage volatilities around it. So it's going to be, I'll try to make it as binary as possible. You'll know you're a winner right away, which is, I don't know how you feel about that, but it'll be binary. I'll try to make it as binary as possible. But some of these spreads that I give you may involve. It may morph into something else as it presents itself, depending on how the situation presents. But I think it'll be, even if you don't do it, you can follow along, watch the process, watch the procedure, and maybe develop your own process of procedure, how you would approach it. This is just looking at, I'm not saying I'm right. I'm wrong. I'm wrong. It's a coin flip with me. I'm as apt to be wrong as I am to be right. But, look, I'm just trying to make risk reward work for me. I want to make technicals work for me. I want to have vol metrics work for me. And I just want, to get enough of those 2 and 3 X's to make up for my 1X losers. And I think I think this will be very, very insightful into how to trade the earnings. And you could indeed, if you really want, although I'm not, but you could be kind of agnostic about direction and still make money here. Or look, Tesla. Look, I've been dead wrong. I thought the stock was going to trade 327. Stock went down. What did it get down? 249 yesterday. We've been talking about this. It's still freaking there.
Yeah.
It's coming. It's still there. If you bought the 25 Delta call, sold the 25 Delta put, sold stock, do it Delta neutral. Do it however you want to do it. This thing's made money 5 or 6 weeks in a row. I haven't done it every time, but it's made money 5 or 6 weeks in a row. If you did it one up, where you're short 50 deltas each one time you get it, you see how I came up with that, right, Mike? I'm long a 25 delta call. That's 25 deltas. I'm short a 25 delta put. That's another 25 deltas, right? So it's 50 deltas. I'm short 100 shares of stock. I'd be short 50 deltas. If you did it one up, you always made money. If you did it half, you still made money. The skew is ridiculous. And like we've talked about. Look at this is yesterday vol, 91 vol in these 25 delta puts. I get it. It's probably going out of business, but like Mike and I have bandied about it many times. It's going out of business. It's going to take a lot of people out on its way to zero, most likely. So I think this skew has been a sale. Historically, this skew has been 7. Today it's trading 17, 19 yesterday. All I'm saying is you got to be real wrong, and obviously you can be. I can be. I know that. I'll speak for myself. You got to be real wrong to lose money on this if you manage your risk correctly. you do it delta neutral, monitor it, take it off when you get paid. Look to put it back on again, because the stock essentially, to me, it looks like it's jump ball every day in there. I have no idea where it's going to open tomorrow, where it's going to close today. It seems very, very random. But let's take advantage of it. Let's take advantage of the fact that it's random. Let's take advantage, and we can let's scrape out some money trading volatility, arbing the volatility here. That's historically the skew here is everyone's bearish. I get it. They can all be right. I don't really care. I just want to get paid along the way. And that's all we're looking to do there in Tesla. We gave you IWM, the Facebook spread. The X spread we gave last week is here's another one, Mike. Baba, is that still listed or has that been delisted? I'm just trying to think.
Yeah, it's still out there.
Is that still out there? All right. Let's hit up a chart of Baba.
Gotten beaten up this year.
Yeah, it's probably not looking. It's probably not looking too good. What was I trying to do? Okay, here.
Really ugly looking chart there.
Yeah, it's a handsome chart, isn't it? It looks real sweet. 260. I mean, what do I have here? 1 year. Why do I have a 5 year chart? 10/10/16. Hold on one second. Technical difficulties.
Mm-hmm.
Okay, so that's I'm sorry, Mike. Hold on. Here's the 1 year chart. Okay, I'm looking in here at Tesla. I think there is a
Alibaba.
I'm sorry. Let me just set this up again. 10/10/2016. Today. Okay. Here I notice 134. Interestingly enough, this gap low 134 would represent roughly, I think, 50%. The all-time, what is this, 86 to 213 is what, 299? I had a different number. Okay. Anyway, here, 134. I mean, it may get down here. It's obviously a disaster. But that said, I mean, look, I mean, I guess people who love trend lines would love being short this thing because it just keeps selling off. That said, variation on a theme, same thing here applies. I think it's at least overdone, right? It's at least oversold, correct? You'll grant me that much. I would look to do something like this. I don't know if I put this in the chat or not. I look at it right here, 144. The recent high in this thing was. Let's look at this. This is where it failed from 170, 168, somewhere in there. Okay, I'll look at 160. I was trying to fashion something around 168. So here we go. 168. I think, you know what? Because, I mean, Larry knows as well as I do. This stuff goes to stupid. When they spike, when they sell off, they go to stupid levels. And to be sitting there and say, well, it's going to stop here. They're going to go to a spot where, where it's not that, where you want them to go, and then they don't stop. So I got to be cognizant of the fact this thing could go anywhere. I think it's so overdone, so unloved. It's probably going to 134. It may go back to 55. I have no idea. But I think if I can get paid doing something like this, I can buy the. If I want to look at the hell is probably not looking at that. Yeah, look at the 157. The 165 spread. You pay roughly 290 against 130. 1 by 2. 260, you're paying 30 cents. Okay, you see this? $2.90.
When do those expire?
This is November 2nd. That's the earnings. We'll leverage everything with the earnings. 157.5 calls, roughly 290. 165.
I'm sorry. So where's the stock trading right now?
Stock trading right now, I believe 140. Is it 140? Hold on one sec. Last. Momentito. 147 spot 73.
And you were just looking at which spread?
I'm looking November 2nd. 157 and a halves.
Uh-huh.
I want to buy one of those. This is November 2nd expiration, 157 and a half. Say I pay $290. Look, you got to bid for these things. Don't run in there and take the offer. That's another thing I get. People got to be bid for. You don't get filled, you walk away.
I'm just thinking, so like 8% above right here, and then which two were you selling against?
Sell the 150, sell the 165s.
So you're talking, you don't
buy one.
You're not getting really hurt unless there's a more than a 15% move.
Correct. So if I pay, say I pay $290, I sell 130 twice. So I pay 30 cents for it, right? So we know we just double the width. So now we make it 172 and a half. We subtract our debit. I got room up to 172.20 on the upside. I'm looking at 168. Obviously 168 is a home run of home runs, right? Because these are worth, roughly, $10.50, and the 67 halves are worth 50 cents. I'm sure the 65. They're worth $3. It's a $5 spread. This is a real cheap upside look. There's a time to be buying, and look, there's a time to be buying volatility, a time to be selling it. Look at this. Here's the 30-day stuff. Now, earnings. I'll preface everything with that. It's inflated because of the recent movement and because of earnings. But let's leverage that. That's fine. That's 41. Typical has been about 31. I mean, we're at the top end of the range here. This is the 32-week. This is the 52-week high in vol. Been about 43. You're getting paid to sell options right now in BABA, right? I mean, for whatever reason, it's all over. I have no idea. They're joining Tesla. They're joining Tesla on the front lawn. Everything must go. So I would do that 157, 165, 1 by 2, pay 30 cents. Bid for it. Don't go in there and buy it and try and hit. Bid for it. Somebody will sell it to you. You got to realize that's like Dostoevsky said, desperate men do desperate things. Something like that. That's a variation on the book, on The Gambler. Most people lead lives of quiet desperation. So I think you bid 30 cents, you got an excellent chance of getting filled in that thing. You just got to take a cheap look on these things because now you're getting paid to sell upside out of the money options in BABA. You're getting paid to sell ETF stuff everything on a relative basis. Historically, not so much, but on a relative basis, you're getting paid to do 1 by 2s in IWM. Now you can fashion upside looks leveraging that. You're getting paid to sell it. STX I think it's kind of washed out. All right, it may fill a gap. There's two technicals. You got gap fill, high vol. I want to take a shot on the long side here. If it doesn't work, is that costing? I'm bidding. I'm doing that for what am I doing for nickel credit? So I mean, if I don't do it, if the stock goes lower, I still make a nickel. Facebook, I put a spread together. I'm wrong on direction. I'm $3 wrong on direction. I'm making money on it. Why? Because the vol metrics are there. That's all. So there's more than one way to skin a cat, and you don't want to look at. And I know you know this, but I just want to say it for anyone. I'd rather just answer the question. Answer the question that might not be asked. The one that isn't be asked is the stupid one. Don't think about where it has to go at expiration. Think about where it may go in the next 2 weeks before expiration and where you can roll out. What you got to do is be right a little bit, and these spreads can pay off a lot. Multiples of. That's what we're going to try to do next week. I'm sorry.
It's interesting as we've been talking. I think right as you came on, or maybe just before you came on, or right during it, news broke that Bill Ackman of Pershing Square has invested $900 million in Starbucks. And I actually saw alerts this morning that there's unusual option activity in Starbucks. And I'm just looking at it. So when the news came out at 1 o'clock, the stock was trading at $57.75. It traded up to $59.70. So that's about a 4% rally on news that Bill Ackman, whose performance has been mediocre, is investing $900 million. So algos took that. But, it's interesting. Yesterday we closed, I don't know the exact settlement, but like 56.50. And I saw that these alerts about unusual option activity. So some people obviously already had it. He was speaking at a conference. They knew that he was going to say it. But, I mean, why are we running up basically Starbucks about 9% at one point from yesterday's close on Bill Ackman? That's just crazy.
Well, let me see Starbucks. I got a pretty good theory. Hold on one sec. Where's my? Was he Valiant? He was in Valiant or Allergy. Which one was he in?
Yeah, both of them. Valiant, definitely.
Yeah, that's great. I love that company. Starbucks. Where is Starbucks? Here it is. I'm sorry.
It's funny. As that news came out, I was taking a look at our old friend HLF. You know, that was the one that he had the big drag out fight for years and years and years, and that one just went up against him. But yeah, so Starbucks.
Oh wow! So this was $49 when the.
No, you're looking at a multi-month chart there.
No, I'm just saying, but in July it was $49.
Yeah, yeah.
It's already had a big move.
But just in the past, yesterday I had a 56.50 price, and we traded up to 59.70. Now we're basically back to almost flat. I think we're about ticking flat from when Ackman released it, which makes a bit more sense.
I'm with you.
It is still having a nice up move on the day. But yeah, so that's just a different sort of note.
Yeah, you're absolutely right. I agree with you.